Welcome to Facts, Figures, and Fallacies from the Frontline podcast with Mitzi E. Sullivan, CPA. Hi, welcome to this episode of our podcast, Pay $0 in Tax Using the 1031 Exchange. My name's Nick Grantham. I work with Mitzi E. Sullivan, CPA, PLLC, and we are in Decatur, Texas. Before we get started, make sure to like and subscribe if you're watching this video on YouTube. And also below in the comments, you'll be able to find our Facebook, Twitter, and LinkedIn page. And also, you'll be able to sign up for our monthly newsletter where we release new tax laws and any other regulations and updates. So again, thanks for tuning in. And I'm going to let Mitzi talk about the 1031 exchange and how you can pay $0 in those taxes.
Okay, so I'm going to begin with a little bit of an understanding of depreciation and amortization and what that looks like on the sale of an asset when you have to recapture those amounts. So depreciation is for tangible assets and amortization is for intangible assets. And when you purchase an asset, you're going to expense that asset over the life of the asset unless you can get some bonus depreciation on the asset and accelerate that depreciation. And everybody loves that, especially this time of the year when people are trying to get rid of all of their taxable income or at least reduce their taxable income so they can lower that tax liability. But what they forget is that when you sell an asset, you have to recapture all of that accelerated depreciation that you've taken on that asset. So we're going to talk about that today, and then we'll finish up by explaining some 5 or 6 things that you can do to avoid that recapture and avoid that tax, and just get to some very strategic business planning when you go to sell an asset. So we'll start with Section 1245 property. So 1245 property is really, and this is Internal Revenue Code Section 1245 and Internal Revenue Code Section 1231. Those are tangible assets like a desk or your computer equipment, a vehicle, things of that nature. And when you sell that property, your depreciation recapture is recaptured as high as your ordinary income tax rate is. So I think the easiest thing to do is look at an example of the purchase of a 1231 asset and the sale of a 1231 asset so that you can see how that depreciation, expense, and recapture work.
Yeah. And timing is key, correct? You're going to go into that, but
yes,
that's what you hammer home as a small business owner. You need to do these things before you sell.
So you'll always, that's exactly right. So you'll always want to contact us before you sell an asset and sometimes before you purchase an asset, because we can structure the buy and sell in a way to really minimize your taxes, and sometimes we can get that to 0 tax. So we'll go ahead and start with an example, and these are very simplified examples. So we're talking, when I say your income tax rate on that would be, I'm talking about your federal income tax. I'm not including if you're in a state that has a state income tax. We're not including that just for simplicity. This is just a federal income tax example. So the first example is a 1231 asset. That's a tangible asset, in this case, a piece of equipment. And in year 1, which is the year you purchase the asset, we assume that you purchased this asset for $300,000 and maybe put a 10% down payment on the asset. So that would be $30,000. This is a 5-year, it's a piece of equipment, so it's a 5-year asset. And let's say you took 100% bonus depreciation, and that bonus depreciation at 100% is still available for the year 2022. So you purchase for $300,000, you're out of pocket only $30,000. You get a $300,000 bonus depreciation deduction, and that, if we assume that you are, in this case, we said you're in a 32% marginal tax rate, that would save you $96,000. So out of pocket $30,000, tax savings of $96,000, and everybody loves that part, but they forget that when you go to sell the asset, you have to recapture that depreciation. Still a great deal. A worst case scenario, you've had a interest-free loan of $96,000 for a year. So let's say you sold that asset in year 2, and you can see in the example, if you sold that exact same asset that you took that bonus depreciation on, and you sold it in year 2, and in this example, you sold it for $400,000. So you have a $100,000 gain on that asset. Most people would think, oh, well, I've held it over a year. That's a long-term capital gain. I'm only going to pay 20%. But that's not the way it goes. So we want you to be aware of that. And as I said, we'll discuss how to get around legally paying tax, or at least reduce the tax that you pay when you dispose of these assets.
Wow. And so as a business owner, Nick, what do we present to you? So we sign on with your services and you do all of our taxes, accounting. What all, I just purchased a new work car. What all do you need for me to get that ball rolling in the forms and stuff?
Yeah, definitely. So we would want your, if it was financed, we would want the finance paperwork that you receive. And like Mitzi said, even if you only put 10% down, if that's what we might see in your accounting software, would be the 10% that actually left your bank account, but we'd be missing the finance agreement. So we need to make sure we have all the information so that we can properly record the full purchase price. And then when tax season rolls around, we can take that bonus depreciation, the full purchase price on that asset.
Mm-hmm.
Yes, and we would also want to see at the end of the year your interest that was paid on that vehicle. So you should get an interest statement from your bank that shows what interest you paid on that vehicle, and we would want to see that too.
Because you write that.
We write that off as well. Mm-hmm.
Okay.
Okay, so back to this example, $400,000, we sold it, and we have a $100,000 gain. The gain on that sale, again, as we said, is not going to be 20% across the board for the whole $300,000 asset. Since we bonus depreciated $300,000, we have to recapture that as a 1245 gain, and that will be at your ordinary income tax rate. So if you saved at 32%, we're assuming a 32% federal income tax marginal rate. If you saved at 32%, when you sell that asset, you're going to pay at 32% on that same asset. So for the $300,000 that you wrote off, you saved at 32%, $300,000, you'll pay that tax at 32%. So your tax savings was $96,000. Your tax cost, assuming all other things equal, would be $96,000. And then the $100,000 gain, because you sold at $400,000, that $100,000 gain, you would get the 20% maximum long-term capital gain on the $100,000. Okay, that is still worst case scenario. Most people aren't going to sell an asset a year after they've purchased it. This is a business property, piece of equipment. Worst case scenario, you've gotten a 1-year tax-free, interest-free loan of $96,000 in this example. Okay, in the second example, we assume that same sale, same purchase and sale of the asset, but we didn't take the bonus depreciation. And we're showing you this so that you can realize whatever you saved, you're going to give back when you sell that asset, unless you take some additional steps. So in this one, we didn't take the bonus depreciation, and it was a 5-year asset. So year 1, we took $60,000 instead of the $300,000. Well, if we sold it in year 2 for the same $400,000 price, we have to recapture that $60,000 that we depreciated the first year. So at a 32% marginal rate, year 1, we saved $19,200. Year 2, we have to give that back if we sold it in that second year, $19,200. And the gain, again, is still at 20%. So if you look at this example, your tax savings was $19,200, you gave back the $19,200, and then the actual gain of $100,000 is 20%. So it works out the same whether we did bonus depreciation or straight line accelerate maker's depreciation on the asset. Whatever you save, you're going to give back, unless you take some additional steps that we'll talk about in just a second. Okay, so that was 1231 property. That's business tangible property. So now let's look at and see what happens when you do Section 1250 property. This is real property. So 1250 generally applies to real property, and that would be like commercial buildings or a residential rental property. Anything that can't be moved, that's fixed to the ground. It may be a workshop, something like that. Okay, if you hold it for more than 1 year and you sell it at a gain, that's called a Section 1250 property. The recapture will be taxed as ordinary income, just like it was for the equipment. And the unrecaptured Section 1250 gain, which will be most of it, will be taxed at a maximum 25% tax rate. So that's a nice difference between tangible property, the Section 1231 asset, and real property, the Section 1250 asset, is the maximum tax rate on unrecaptured Section 1250 gain is 25%. So if you depreciated and your ordinary marginal tax rate was 32%, you're only taking the unrecaptured gain at 25% maximum. So that's a nice tax savings, even if you sold that asset in 1 year. And that's for real property. So that's the second example. And what we like to do when we're purchasing real property, and again, this is not tax or legal or investment advice. Everybody's situation is different, so you'll always want to consult your own CPAs and attorneys and make sure that these apply to you. This is one thing that we like to do is a cost segregation analysis. So in this example, we purchased, instead of a piece of equipment, we purchased a piece of rental property. And we still spent the $300,000. We had a 10% down payment. But instead of calling the entire $300,000 less the land piece of it a building, we can segregate out the 1231 assets, and that would be things like the furniture, fixtures, land improvements, building improvements, things like that, through a cost segregation analysis. And we're going to do a podcast on that, and we will link that here so that you can get more details on that. But in this example, we've already done the cost segregation analysis, and we were able to get bonus depreciation of $106,000 because we took those 1231 assets and took 100% depreciation on those assets. That sounds great. People love that because with the bonus depreciation, you can generate a real estate loss if you're a real estate professional or you're under the cap, and we'll have a podcast on that as well. But you can generate a loss where you can't with the 179 deduction. With the bonus depreciation, you can generate a loss that will offset your other income. And that's why people love this. But what they don't remember is that when they sell that asset, there is the unrecaptured gain and also Section 1245 gain on the 1231 property that you took the bonus depreciation on. So that is just one thing that you want to make sure you remember.
And how do you break that down? So when a client comes in and they sign up for services, you're part of your onboarding process is are you purchasing property? If so, what kind? That's a part of the onboarding process.
Right. And then we keep up with that all year long. Mm-hmm. So anytime we have a client that purchases or is getting ready to purchase a business or a major asset or sell, especially on the sale of a business or a major asset, we want to be involved in that transaction because we can structure it in such a way that it can minimize the taxes and sometimes just avoid the tax altogether.
Right. And do they have to request the cost analysis, or is that just something that you run on every client? Or
well, the IRS actually requires a cost segregation analysis performed by an engineer. That usually runs $1,200, $1,500, up to $2,000. Okay. And then we'll take the numbers off of that. That is a requirement. I feel like it's unnecessary because it almost always comes out to about 1/3 of the building cost. We can take accelerated depreciation. We can take that bonus depreciation on.
And in these next couple years, while bonus depreciation is still available, it is absolutely worth paying for that cost segregation analysis just based on how much you can save in the current year,
right?
Rather than pushing that out and spreading that out over 27 and a half years or whatever the depreciation life may be.
Right. And we're going to do a podcast on the cost segregation analysis, and that way you can have more information and more details on how that works. And so on our example where we saved, this is very interesting. In this example, we took $106,000 in bonus depreciation at a 32% marginal rate. We saved $34,000. Well, our down payment on this particular piece of property was only $30,000. So we're out of pocket nothing, and we actually have $4,000 back in our pocket. So when you're calculating your cash on cash return and you have no cash in the deal, that's when you get those infinite returns, and people love that. But be careful when you go to sell, and there are things we can do on the sale to keep you from having to recapture and lose everything that you've saved on that. So we'll look at a couple of different ideas that we have, some of the things that we like to do to avoid paying tax on the sale. So probably the most popular thing that we do is the 1031 exchange, and this is on the sale of real estate. And we'll have a whole podcast on the 1031 exchange. But if we know ahead of time that you're considering selling an asset, we can call to your attention, hey, we've taken this much depreciation on that asset. You will have to recapture that unless you do some of these other things that we'll talk about. So the first one is the 1031 exchange. And that's when and there are lots of rules and regulations that you have to follow when you do the 1031 exchange. But that's when you exchange basically one piece of real property for another. And this does need to be business property. And when you do that, there is no gain on the sale of that asset because the IRS considers that an exchange. So 1031 is probably one of the most popular things that we do. Then another thing that people will do, if they're not doing a 1031 exchange, they'll go ahead and purchase another property, and maybe it's not part of the exchange, but with the cost segregation analysis, they can generate enough loss on that property to offset the gain on the first property. So that's another strategy that we see a lot. The third one, which it has to do with the cost segregation analysis again. So you did that cost segregation analysis when you purchased the property to shift the cost of the property into a 1231 asset, as much of it as you can. Well, when you go to sell it, you want to shift the other way. So if you'll order another cost segregation analysis when you go to sell that property, we can shift that purchase price, or we can shift that sales price of the asset back into the 1250 asset and out of the 1231 asset. And you will have a significant savings on that as well, because things like your carpet and your appliances, maybe that you paid for when you purchased the asset, now don't have any value, because you've rented it for 3 or 4 or 5 years, and those assets have lost value. So we can shift that sales price and have it go to the building and not to these 1231 assets. So that would be the third thing, the third strategy we see a lot. And the fourth strategy, again, we'll have a podcast just on this strategy, but it's an opportunity zone. And Decatur, for one, has a great large opportunity zone. And an opportunity zone is where when you sell a property, you can purchase a property in an opportunity zone. And with some rules and regulations, you hold that property long enough, again, no tax, no capital gain on the sale of that property. So that's another very popular way of avoiding all tax on the sale of an asset. And we'll have a podcast on that, and we'll link it to this podcast.
And I know we'll talk about it then, but the opportunity zones, is there a time limit on that?
There is. There's a time that you have to hold the property. So if you want to completely eliminate the capital gain, I believe it's 10 years that
But
you have
as
to
far
hold
as it being an opportunity zone, they haven't established a deadline. Like, this program is only going to be good until this year.
Not that I know of. So
Okay.
I'll have to check on that when we do a
that's good.
podcast. I'll give
Okay.
you that information. Okay, and our final strategy would be shifting the income to a lower year. So let's say you dispose of an asset, you absolutely can't get rid of the capital gain. You can take that income and shift it into a year where your marginal rate is lower.
Mm.
So if I know I'm going to sell a piece of property or a piece of equipment, and I've had a lot of great, like 2021 was a huge income year for a lot of clients. Well, don't sell your fixed assets in 2021. Sell them in 2022 when you're have a lower marginal rate. So that is a way. There's always a way to structure the buy and sell of asset, the purchases and sales of assets, to get the best, put yourself in the best tax advantaged position.
Well, that wraps up today's episode. Thanks so much for tuning in. And please do watch our other videos on opportunity zones, the 1031 exchange, cost segregation, being a real estate professional, and self-directed accounts. So thanks again, and we'll see you next time.
Thank you for tuning in to today's episode. Make sure you follow us on Facebook, LinkedIn, and Twitter at the links below. Also, sign up for our weekly newsletter to make sure that you stay up to date with the changing tax laws and regulations. Leave a comment if you have any questions about today's topic. We'll see you next time.